When people hear the term whole life insurance, they often wonder, does that mean that I'm going to have coverage for my entire life? Or does that mean I'm going to be stuck paying premiums for my entire life? And that's a relatively common question that we get. And today I want to clear it up. Whole life insurance is called whole life simply because of the fact that the coverage itself is permanent. As long as the policy is being properly funded, it's designed to last for your entire lifetime. And so I think the word properly funded is one of those like buzzwords that we throw around from time to time. We know exactly what it means, but just for the sake of over communication for you, properly funded simply means that your policy is getting the money it needs from one of two places. Number one is that it's coming from outside the policy, or number two, it's coming from within the policy, right? So from outside the policy simply means that you're making premium payments. From inside the policy, that means that the policy has built enough cash value to actually fund itself. And so that's the key. It's either going to be you fueling it, or it's going to be strong enough to sustain itself. So what I want to do next is show you 3 different policy examples. You'll notice that all 3 of these policy examples are effectively the exact same policy. The only difference is after we get a little bit further into the policy years, we're going to show a little bit of a different funding strategy to show you that you don't have to continue to make contributions to the policy. It can fund itself, although you could, and you can kind of see the impact of that in a moment. So before we get into the nitty gritty of the policy in and of itself, I just wanted to show you a little bit about the background of the person, quote unquote person that we're looking at here. So we got Carter Cashwell. He's a male, he's age 40, preferred health rating, not tobacco, right? And we're showing $100,000 of contribution premium per year. Just note also that the minimum contribution is $19,307. And what you're going to notice is by that 16th year, the premiums drop from $100,000 all the way down to $19,307, which is a combination of the base policy premium and the term insurance rider. And the reason I did that is just to kind of show you an example of what it would look like if you decided to stop making the maximum contribution at that particular point in time, but there's nothing necessarily magical about dropping premiums after year 15 per se. So in this 15th year, this is the last year in which all 3 of the policies that I'm going to show you end up looking exactly the same. But then moving forward, what you're going to find is that this premium outlay column is what's going to be different. This cumulative premium outlay column will also be different. And then the total cash value as a result of that will also be different. And so just to kind of keep things level here, the premium outlay or the cumulative premium outlay, that ultimately means either the dollars that have gone into the policy out of your pocket, either up to that point, which would be the cumulative premium outlay, or within that particular year, which is the premium outlay column. So in this 16th year, $19,307 is going into the policy from an outside source, being the person who's paying the policy. When they continue to do that over the next 10 years, what you're going to notice is by that 25th year, $1,693,067 has gone into the policy cumulatively over the course of the total 25 years. That results in a cash value of $3,901,468. And what I want to do here is contrast that to a policy that's designed very similarly, but the only difference is instead of the policy premiums coming out of your pocket, they're actually going to be paid for by the policy in and of itself. And what that results in is a cash value that's a little bit lower as well. And it makes sense because 1.5 million is what the cumulative premium outlay was by the 15th year, and it remains at 1.5 million every single year, all the way through year 25, as we're showing in this example. That results in this $3,637,725 of cash value. That's a $263,743 difference. And that doesn't necessarily mean that one is better than the other. But what it does show you is the impact of you turning your policy from being funded from an outside source like yourself to being funded by itself from its own cash value. Now, the last example I want to show you is a little bit peculiar because what you're noticing here is that the premium outlay is zero, but it's only zero for 4 years. And then it ramps back up to $19,307 or that minimum contribution that I referenced before. The reason I'm showing you this one simply revolves around the fact that I just want to highlight the fact that you don't necessarily have to be beholden to committing to the $19,307 every single year for the rest of your policy years and the rest of your life, nor do you have to be beholden to only $0 moving forward for the rest of your life either. Because one of the things that you'll notice, if you haven't noticed already, is that of course you're having a healthy level of cash value, whether or not you add contributions to it or not. But when it comes to wanting to have a boost in your cash value, it makes sense to make more contributions if you have the cash flow to do so. And so again, if we're looking at that 25th year, now $1,615,840 has been contributed to the policy by that point in time. And we're looking at $3,778,409 by that 25th year in terms of cash value. Hey, it's Demetrius. Just want to pause the video real quick and let you know about our education hub that we call The Vault, because the reality is most people have no idea how to evaluate whole life insurance. And so The Vault is a collection of all of our best resources and educational tools to help break it all down. So there's a calculator, a handbook, a crash course, a deep dive videos on all of the numbers. You have all of that in one place and all for free. And so go ahead and click the link in the description or the tag comment below to unlock your access to The Vault. Now back to the video. So the point that I'm making here is that whether you stop premiums, you continue premiums, or you add occasional contributions to the policy just to kind of boost the policy's cash value even more so, the key is that you have options. You're not going to be beholden to, $0 after year 15. You're not going to be beholden to having to make contributions for the rest of your life, nor will you be beholden to anything that you see directly in the illustration, because there's a lot of flexibility that you're going to see that you have within these life insurance policies. Remember, when we're showing you these life insurance policies, we're showing you a snapshot. We're also showing you a snapshot of one particular illustration, and there's so many variations that could be built, and there's so many variations that could be spelled out in reality as well, because life happens in the positive direction, life happens in the negative direction, and either way, we want to build your policy in such a way that you have the flexibility to make various levels of contributions along the way. So when you hear whole life, don't think lifetime of payments, right? Think a lifetime of protection, right? Think lifetime of flexibility to choose how long you want to contribute, right? The longer you fund, the stronger the growth. But even if you stop, your policy can still sustain itself for life. And if you want to see how a whole life policy could be designed for your situation specifically, whether you prefer to fund it for 10 years or 15 years or 20 years, or keep it going for as long as possible, go ahead and schedule a call with our team. We'll walk you through real illustrations so you can see exactly how the options would play out for you in conjunction with the goals that you have set for yourself. So thanks for watching. We'll see you in the next one.